towards copy trading. This is the third episode of the Essential series, and in this video, we'll be focusing on liquidity and specifically about the sub-variables within liquidity, which we could use to either avoid or minimize falling into smart money traps. So when we talk about liquidity, first of all, we'll have to understand about the two forms of liquidity based on either formation and function. When we consider formation, here specifically, we need to identify where a specific liquidity is formed. So when we consider formation, and we'd actually be talking about two types of liquidity, which is structural liquidity and engineered liquidity. So when we talk about structural liquidity, this is basically the type of liquidity which is formed within the impulse leg of price. So anything that is formed within the impulse is called structural liquidity. And here you can actually have two different forms. The first is internal liquidity, which means this is formed before the breakout structure. So this would be an internal liquidity. And the other would be an external liquidity, something like this. So when we consider structural liquidity, we have two, which is internal and external. And then when we consider engineered liquidity, what we are talking about here is about liquidity which is formed within the RTO leg, so within the retracement. So something like this. This would be an example of engineered liquidity. And we call this as type 2 inducement. So if this is type 2 inducement, then the structural liquidity is what we call type 1 inducement. So based on formation, we have two types, structural and engineered. Structural would be when liquidity is formed in the impulse leg, and engineered would be when it's formed in the retracement leg. And that is based on formation. And then we can describe liquidity based on function. And when we consider liquidity based on function, that would be either as major liquidity, or trapping liquidity. Any three of the structural liquidity types, so basically based on formation, when we consider any of these three, they can act as major liquidity. And what we mean by major liquidity is basically when we consider a range, this is going to be the main liquidity within the range which would be used for order value. So for example, assuming something like this, one could consider this as a major liquidity when we consider this whole range. And the same goes with any of the three types. But the difference between major liquidity and trapping liquidity is that trapping liquidity acts as an additional layer of liquidity, which traps buyers or sellers before the actual. So it's something like this. So in the retracement, you can have something like this. And this may or may not be type 2 inducement. It cannot be internal or external because that won't be present in the retracement leg. And when it is present in the retracement leg, it can either be type 2 inducement or it could be something smaller than that. But the logic behind this understanding is that it acts to trap buyers or sellers before the actual move. So in this case, it's a bullish scenario, which means this trapping liquidity is responsible for taking out early buyers. So when people buy early, they're trapped here, and then that is liquidated and the real move happens. So this is basically how we can categorize liquidity based on formation and function. And then we have to consider about liquidity in relation to ranges. So basically what we are trying to do here is combine our understanding on how liquidity is relevant within a particular range. And here we have three factors which can be used, which is size, location, and range degree. And first we'll focus on range degree. So this is mostly applicable for structural liquidity. And it is basically this. Assume you have a range. And when we consider a similar type of range, the creation of a similar type of range, it can happen in one of two ways. The first is the mitigation of an extreme. And the second is liquidation of minor structure. So in case of liquidity, this is almost always going to be this second factor, because if it is the first factor, you'll more often than not have enough space for PY. So if you consider this as a range, the creation of a similar range would look something like this. So you have minor structure here, and this minor structure is taken out, and you have a breakout structure, which means this here now would be of similar degree to this. And this is important because for an external structure to be formed, you need this liquidation. Because you can have multiple structures here, but how are you going to define which of those highs or lows is going to be the actual liquidity? This is how you do it. And the same logic applies to internal structures. The only difference is you are going to look at it internally within the range. So okay. Assuming the same scenario. And here you have the breakout structure. So if it's internal, whatever is formed should be formed within this. So what you're looking for is some sort of minor structure to be formed. Then that is taken out, and you have this one. And this would mean this would act as minor structure, and the same logic applies here. So this is about range degree. The same can be used in the RTO, like for type 2 inducement. And in that case, what you're looking for is something like this. Again, you need some sort of minor structure, and then that is taken out. And here you have a valid type 2 inducement. It's the same logic across all three forms of liquidity. And now when we come to size and location, this is going to be important. So when we consider a range again, you may have any form of liquidity of what we discussed at different points of this range. So for example, you can have two scenarios here, same range. One, you could have liquidity somewhere here, something like this. And here you could have it somewhere like this. So how are you going to define which of these is more valid or holds more validity than the other? And for that, we can use size and location. As a general rule of thumb, the larger a liquidity is, the more valid it is. And the closer a liquidity is to your point of interest, so which is here, the higher validity it has. So the larger the range, the higher the validity. The closer the liquidity is, the larger the validity. So what people should understand is how are you going to implement rules to define that? So your question should be, how are you going to assign some sort of value to this in relation to the range? And how are you going to assign a rule for the location in relation to the range? Because those two are going to be important, because that is how you can identify if a relevant liquidity pool is valid for your range. Because when you think of this, assume you're considering both as liquidity. So you consider this as liquidity. You consider this as liquidity. So when price comes here, is this actually a liquidation, or is this acting as an impulse? Versus if price comes here, now, is this acting as a liquidity, or is this acting as an impulse? So when we consider these two examples, we can make an assumption that because this is closer to the point of interest, and we can consider size and location as well, this might act more as liquidity versus this, because now this is much further and this could actually be an impasse. This is why we use these three factors to identify whether a liquidity is actually valid to a range or not. And the logic behind this is actually this on how we identify liquidations versus breakouts. So when we consider liquidations versus breakouts, we'll just use the same range. And we'll assume we have some sort of liquidity here. Or rather, we'll assume a large liquidity. So let's say something like this. And you have your PY. And we'll assume two different scenarios. The first is price comes here and does something like this. And the second is price comes here but goes much deeper and does something like this. So when we consider these two scenarios and assuming we have a liquidity pool somewhere around here. Now, in which scenario is it more likely that it's actually a liquidation that is taking place rather than price just going straight through it and forming an impulse? So here we actually get something like this. Okay. So which means if it is actually a liquidation, then your expectation is price is going to take out that liquidity, not travel too much, and change direction. If it is not actually a liquidation, then price is most likely to do something like this. It will give you some sort of reaction, but then go on in its current direction. So which means you have to find a way to mechanize this distance from the liquidation. So assume this is where you consider that a liquidation is no longer taking place. So as long as price stays above this line, you have a liquidation. But if it doesn't, then it's not actually a liquidation anymore. So how are you going to assign a value or have a rule for this level? At which point you can decide if it's actually a liquidation or a retracement for the existing. This is important because once you know this, you won't consider every liquidity as a liquidation, because like we talked earlier, if something is so far away, so something like this, is this actually liquidity for this range when price is at this point? It's probably. But if you had some sort of liquidity like this, now the probability of this acting as liquidity and giving you the actual is much high. So you can use these three factors and add in what we discussed here to identify what is the true liquidity and what is the actual liquidity which will be used for order pairing within a range. And then we'll be talking about trapping. And here again, we'll be using the factors of size, location, and time. The same of what we discussed here. So we talked about trapping liquidity. So let's assume you have a range here with liquidity. You have your point of interest here. You have your liquidity here. And trapping is basically what happens to the early buyers here in this scenario. So this would be your trapping liquidity. And now again, what is the purpose of this trapping liquidity? The first is to trap early buyers. And the second is to add to this pool of orders, right? So which means you are going to have some orders below this point and few more below this point. So how are you going to understand that the orders that are accumulated below this point is going to be sufficient to support this move? So again, you can use size, location, and time. So how large is this going to be? That is one factor. And you could also use the period of accumulation. So assume you have something like this here, because the larger the time taken for this accumulation, the larger the pool of liquidity is going to be. So you can use those two factors and location. Again, like what we talked about here, this should actually be a liquidation and not a breakout. So where this is located is also going to be important. So once you combine all of that, we can actually come to a conclusion whether this liquidity pool here is actually sufficient to support this move or not. If it is sufficient, it will give you a move. If it is not, you'll probably have something like this. Or this could actually form further liquidity and then give you a move like this. At which point, this would actually be another layer of engineered liquidity. So here we can't actually confirm something before it happens. So we'll have to wait, see what price does, and depending on what it does, we can actually decide on if it is sufficient or not. And then we have the IPA and SMT misconception. So in the previous video, one of the things that we discussed is if you have IPA in between two ranges, so this is going to be your IPA, then the likelihood of this being liquidity is going to be high, which is true. But one of the other things that we have to keep in mind is the presence of an IPA below a range does not automatically make this low probability, because we know that price moves with liquidity, right? Because if a range has enough liquidity, then does this actually need to be filled? The answer is no. So assume you had something like this. You have a lot of liquidity here. In a case like this, you could actually use this liquidity and price could actually give a high probability move from this POI without taking that out. So the misconception of that, the presence of a fair value gap, that is what is an IPL. Below a high or low is going to make that high or low probability is not real accurate. That actually depends on if that range has sufficient liquidity or not. If it does have sufficient liquidity, then it can act as a high probability POI. And if it does not have enough liquidity, then slow could be liquid. And this is in isolation, because if you have some sort of high time frame liquidity or POI against this, then obviously these are going to be liquidity. So you have to take it in context of everything. But if we consider this in isolation, there's no reason for this to be low probability than any other high or low, just because there is an IPA below it. Because what's most important is the presence of sufficient liquidity above your POI. And then we are going to talk about time-bound liquidity in the normal sense, which I think is pretty incorrect. Here, what we are going to talk about is what people consider as time-bound liquidity, which is previous days, weeks, or months highs and lows. So assume something like this. You have some sort of range, and you have this, and then let's just assume price does something like this. So some people, let's assume price is somewhere here, and this is the high of this day. And some people just use this high as previous day's high and attempt to consider this as a liquidation for a move down. Now, the problem is, yes, this is previous day's high, but why can anyone think that there is sufficient liquidity above this point? Because the move here is very small. So because this is very small, and you could also use time here in the sense of accumulation, if those are small, then the amount of liquidity present here is going to be minuscule to support any significant move down. On the contrary, if we consider something like this, and let's assume we have some sort of POI here. Now, if price does something like this, at this point, then yes, this is previous day's low, but this is also being supported by this liquidity, which is a relatively significant pool of liquidity. So in this case, yes, you could use this as previous day's low, but the main point you have to consider is the size and the accumulation of this liquidity. This comes second, time comes second in this scenario, because without an accumulation of orders, time itself cannot act as liquidity. So you have to keep this in mind when we are considering time-bound liquidity, because just because it is the previous day's high or low, without context, you cannot use it. That's the first point. And the second, the actual price action supporting that high and low, whether there is enough liquidity, is going to be the major factor when you consider that. And here you could also think about what this point is actually forming. So what I mean by that is this going to create the high or low of the session or the day or the week or the month? Depending on that, you could also consider the extent to which this formation should be. So for example, if this is going to be a monthly low, then the amount of liquidity that you need to support a monthly move is going to be significantly higher than if this was a sessional low. So the amount of liquidity present should match with what you are trying to trade. The larger the expected move is, the larger the pool of liquidity you need. Okay, so this is basically what we are covering in this video, and I'll just give you an example of some of these concepts on the real charts, which is actually a trade that we took last week. And here, so when we consider this pool of liquidity, like I said, this is not close to a POI here. So which means when I look at this is probably not going to be relevant to this range, which is why I actually use the range here. You won't see it here, but if you go to a lower time frame, you'd actually see the range. So you can see here, you have a range, you have external liquidity to this range because it's formed after this point. And now this is very close to your POI. So the validity is high, and it is relatively large when you compare the range itself. And a further important point here is you can see this, right? So when price takes out this liquidity, it did not give a large move, which means now this is more likely to be a liquidation rather than an impulse in the bullish direction. The same applies here. You have engineered liquidity here acting as trapping liquidity. So you have trapping liquidity here. And when price took that liquidity, again, you don't see an impulse. You just see a small move up and then back down, which means both here within the trapping and within the major liquidity, you are likely to have a liquidation rather than an impulse, which makes both of these high probability. And again, the formation here means you are going to have a lot of orders above this point, which can be taken out to support this move. And when you look at this, this is going to be the high of the day, right? That is our expectation. So you have to decide if this and this is going to be enough liquidity for this move. Now, if you assume this to be a monthly high, then this is probably not going to be enough. But because in this case, it's just going to be a daily high, then this is going to be enough. So this is how you use it. So this is just one example where I could give you some logic behind this reasoning. But again, like another reason is, am I going to use this as liquidity for this range? No. Why? Because this is formed much lower into the range, and when price moves up, now is this actually a liquidation of this, or is this an impulse in the bullish direction? So in this case, I'm going to consider this as an impulse in the bullish direction. But here, this is where you actually get the trap, which is why I haven't considered this as a valid liquidity, but rather this as the major liquidity and this as the engineer liquidity, the trapping liquidity. So I hope you understood most of what we discussed today. And in the next video, we'll talk about order flow, which is where we'll actually merge ranges with liquidity, and you'll probably get the most understanding. So see you in the next one.